Welcome to the Pro Ticker Deep Dive.
Hey, it's fantastic to be here.
So today is Friday, February 2026, and I have to be honest with you, walking into the studio today, the atmosphere out there in the markets, it just feels heavy.
Yeah, it feels tense, really tense.
It really does. It feels like the calm before the storm.
That is exactly the only way to describe it right now.
Right, because if you have been anywhere near a financial terminal this week or just doom scrolling through financial Twitter, you know that the entire financial world is basically holding its breath for next Wednesday.
Right, February 25th. It is the only date that matters right now. Everything else is just noise.
We are talking, of course, about NVIDIA's fiscal Q4 2026 earnings report. But I think we need to frame this correctly right at the top for everyone listening. Because this doesn't feel like a normal earnings call anymore.
No, definitely not.
This isn't like waiting to see if a big retailer sold enough toaster ovens over the holidays.
Right. It has evolved way beyond that.
Yeah.
It really feels like a macroeconomic event.
It does. It feels like we are waiting for a highly anticipated inflation print or a Federal Reserve interest rate decision.
That's a massive jobs report. Yeah.
Exactly. It feels like this one single report is a referendum on the entire global economy, or at least this new AI economy that we've been promised for the last 3 years.
I think that's a very fair assessment. When you have a single company that has effectively become the utility provider for the next industrial revolution, their health really is the market's health.
Yeah, that makes sense.
But I think the anxiety this week stems from something very specific. We have had 3 years of hype.
Oh, absolutely. Nonstop hype.
We have had the wow factor. But now in 2026, the market is demanding proof. They don't want poetry from a chatbot anymore.
They want to see the return on investment.
Exactly. They want to see the receipt.
And that is exactly our mission for this deep dive. I know you listeners out there might be feeling a little bit of AI fatigue at this point.
Which is totally understandable.
Right? You hear about large language models and GPUs and parameter counts every single day. But today, we are going to cut right through the marketing noise.
We are not here to talk about the magic of AI today.
No. We are here to talk about the plumbing, the power, and the money.
The hard numbers. And I have to say, the numbers we have to discuss today, well, they are frankly staggering.
They are eye-watering. So we are going to unpack the $700 billion infrastructure arms race that is accelerating right this second.
It is massive.
We're also going to talk about the Stargate project, which I know sounds like bad sci-fi, but is actually a very real $500 billion geopolitical play.
One that could change the U.S. energy grid forever. It is effectively the Manhattan Project of our time.
We will also get into the silicon itself, the transition from the Blackwell chip to the new Rubin architecture, and why that transition might actually be really dangerous for the stock price next week.
Yeah, that transition is a huge potential trap.
And finally, we have to talk about the ghost cities risk. Are we building infrastructure that no one will actually use?
It's the ultimate bear case, and we absolutely need to face it head on.
So let's start with the money. Section 1 here. The $700 billion poker game. We are calling this the infrastructure sprint.
And it really is a sprint, but a sprint with marathon distances.
When I first looked at the CapEx, the capital expenditure figures for 2026, I actually thought there was a typo in the spreadsheet.
You are not the only one.
I literally thought, okay, surely they added an extra zero here by mistake.
No typo. The scale is just hard to comprehend because we have never seen anything like it before.
Let's break it down for everyone. We are looking at the hyperscalers, the 5 biggest players. Microsoft, Alphabet, Amazon, Meta, and Oracle. Just those 5. What is the combined spend we are looking at for 2026?
Collectively, those 5 entities are committing between $660 billion and $690 billion in CapEx for 2026 alone.
Nearly $700 billion. In one single year.
Yes. To put that in context for you, that is nearly double what they spent in 2025.
And 2025 was already a massive year.
It was already a record-breaking year. It was the year everyone looked at the numbers and said, wow, look at this spending.
Right.
If you adjust for inflation, this is the largest, fastest capital investment build-out in human history.
Wait, bigger than what exactly?
Bigger than the build-out of the rail systems in the 1800s. Bigger than the electrification of America.
Wow.
Bigger than the telecom boom of the late 90s relative to the size of the companies involved. We are watching the industrial base of the planet being rewritten in real time.
That comparison to the telecom boom makes me a little nervous. I want to put a pin in that for later because we all know how the dot-com infrastructure boom ended.
Oh, we will definitely circle back to that.
But let's look at who is writing these checks right now. Because Amazon seems to be almost panic buying.
Amazon is absolutely aggressive right now. They have a projected $200 billion CapEx plan for 2026.
$200 billion.
Yes. And what is really fascinating here is that this number completely shocked Wall Street.
They weren't expecting that.
Not even close.
Yeah.
The consensus estimates from the big banks were much lower, around 140 or 150 billion.
Okay.
But Amazon came out and said, no, we are going all in, 200 billion. Now, to be fair, Amazon does have a massive logistics network.
Right. The trucks and warehouses and delivery drones.
Exactly. So some money obviously goes there. But the data shows the vast majority of this increase is purely for data center compute.
It feels like a poker game where the blinds just went up and Amazon just shoved their entire stack into the middle of the table.
It is a poker game. But then look at Alphabet, Google. They are targeting between 175 billion to 185 billion.
That is right behind Amazon.
And this is where it gets really nuanced. Sundar Pichai, their CEO, actually admitted in recent call that the scale of this spending is, quote, concerning.
That is a word you very rarely hear a tech CEO use about their own strategy. Concerning. Usually they say bold or strategic or visionary.
Exactly. He is acknowledging the risk out loud. He is saying, I know this is a scary amount of money.
But he is doing it anyway.
But he followed it up by saying it is necessary. He revealed they have a cloud backlog of roughly $240 billion.
Can we pause on that phrase for a second? Cloud backlog. I want to make sure everyone understands exactly what that means in this specific context.
Sure. A backlog is essentially signed contracts or committed orders from customers that you simply haven't fulfilled yet.
Okay.
So Google has customers, enterprises, startups, governments lining up waiving contracts worth $240 billion saying, we want to rent your AI servers.
And Google has to say wait.
Google has to tell them to wait.
Because they don't have the server.
Because they physically cannot build the capacity fast enough. They don't have the chips, or more likely they don't have the data center space and the cooling and the power ready to go.
So this isn't a field of dreams situation. They aren't just building it and hoping people come. The people are already camped out in the parking lot with cash in hand.
Exactly. And that is the core difference between the AI bubble narrative and the AI supercycle narrative. Well, in a bubble, you have supply wildly exceeding demand. Think of the dot-com crash. Pets.com selling dog food online that no one really needed at that scale.
Right.
Here we are, completely supply constrained. Microsoft is another perfect example of this. They disclosed they have an $80 billion backlog for Azure.
$80 billion just sitting there waiting to be collected.
They are leaving money on the table every single day because they cannot plug in enough GPUs to serve the customers. They are physically unable to take the money.
That perfectly explains why Microsoft is tracking toward $120 billion in spending. They are just trying to catch up to the money that is already waiting for them.
Correct. It is a desperate race to capture the demand that already exists. And then you have Meta, Facebook. They're planning up to $135 billion.
Wow.
And this includes a single facility in Ohio that is targeted to be 1 gigawatt.
We keep throwing around this term gigawatt. I think for most
Oh.
people listening, that is just a funny word from Back to the Future. You know, 1.2, 1 gigawatt.
That's it.
But in the world of data centers, what does a gigawatt actually represent in physical terms?
It is a massive, massive amount of energy.
Yep.
To give you a mental image, 1 gigawatt is roughly the output of a standard nuclear reactor.
Okay.
Or, to put it another way, it is enough electricity to power about 750,000 to 1 million homes, depending on how you measure the efficiency.
So Meta is building a single building in Ohio, one facility, that consumes as much power as a city the size of San Francisco or Amsterdam.
Essentially, yes. Just to train and run their AI models.
That is terrifying and impressive at the exact same time.
It really is.
But even Oracle is in the mix now. They used to just be the boring database company.
Oracle has completely reinvented themselves as a critical infrastructure player here. They're targeting $50 billion in CapEx.
Which sounds kind of small compared to Amazon's $200 billion.
It sounds small, but for Oracle, that is a 136% increase over 2025. They are more than doubling their physical footprint in a single year.
So the why here, it seems to be fear. Is it just pure FOMO, fear of missing out, or is it actual fear of extinction?
It is a classic prisoner's dilemma. Think about it. If Google stops spending, but Microsoft keeps spending, and Microsoft achieves a breakthrough in AGI.
Artificial general intelligence.
Right. If Microsoft gets AGI first, then Google becomes instantly irrelevant. Their search monopoly dies overnight. Their ad business dies.
So they have to spend even if it hurts the bottom line today.
They have to, because the cost of inaction is death.
It is a corporate arms race where the only way to survive is to buy more bullets than the other guy.
And speaking of arms races and massive power requirements, we have to talk about Stargate.
Yes, the Stargate project.
When I first saw this name in the research, I genuinely thought someone had slipped a movie script in by mistake. But this is a very real project.
It is very real, and the scale of it is almost hard to wrap your head around. Stargate is a massive joint venture. The primary players are OpenAI, Sam Altman's crew, and SoftBank, led by Masayoshi Son. Masayoshi Son, he is the guy who writes the biggest checks in the history of tech.
He is totally known for making the biggest, riskiest bets, which is a dangerous combination potentially. You also have Oracle involved on the infrastructure side and MGX. The plan calls for a $500 billion investment through 2029.
$500 billion
Yeah.
for one single infrastructural project.
With an immediate deployment of $100 billion, they aren't waiting around. They are breaking ground right now.
But this isn't just a purely commercial venture, is it? There is a national flag wrapped around this one.
Correct. This is where the geopolitics really enters the chat. The project is heavily backed by the Trump administration. It is being explicitly framed as a strategic national asset.
Okay.
Think of it sort of like the Apollo program or the Manhattan Project.
So the U.S. government is actively involved here.
They are supporting it strongly because the administration views this as critical. The mindset is that if AGI is going to exist, it absolutely must be American.
Right, it has to be on our soil.
It must be built on U.S. soil, powered by U.S. energy, and controlled by U.S. interests. They simply do not want the first superintelligence to be born in a data center in Shanghai.
So it is national security achieved through computational superiority.
Exactly. And because of that national security angle, they are bypassing some of the usual regulatory hurdles that would normally slow this down. They are planning 5 massive sites across Texas, New Mexico, and Ohio.
Okay.
But here's the real kicker. The Stargate project is planning for roughly 7 gigawatts of power capacity.
7 gigawatts. Okay, so we just established that 1 gigawatt is basically a nuclear power plant. So this is 7 nuclear power plants worth of juice.
Correct. To put that in perspective for you, the entire current data center consumption of the United States, everything from Netflix to your banking app to Facebook, is roughly 25 to 30 gigawatts total.
Total for the whole country.
Yes. So this one single project represents a massive percentage increase in total U.S. power demand.
Where do you even get 7 gigawatts of power? You can't just plug that into the local grid in Texas without the lights going out in Dallas.
You absolutely cannot. That is exactly why this is primarily an infrastructure and energy project, not just a tech project. They are talking about building dedicated power sources from scratch.
Like what?
They are heavily looking at small modular nuclear reactors, SMRs. They are talking about massive solar farms with utility-scale battery storage. They are effectively having to build their own utility company just to run the computers.
It really highlights that AI isn't really software anymore. It is heavy industry. It is steel and concrete and uranium and water rates.
That is the big paradigm shift for 2026. We have entirely moved from code to concrete. It is about land rights and high-voltage transmission lines now.
So all this spending, the $700 billion from the hyperscalers, the $500 billion for Stargate, it all flows into one giant funnel. It all ends up in the bank account of one specific company. Which brings us right back to next Wednesday, February 25th, the earnings report. Let's look at the expectations here. What is Wall Street actually looking for?
The official consensus forecast, the safe number that the analysts publish, is for revenue right around $65 billion for the quarter.
Just for Q4.
Just for 3 months of business. That represents year-over-year growth of roughly 66 to 70%.
Which is completely insane. I mean, usually when a company gets to be $1 trillion in size, it grows at maybe 5%, maybe 10% on a great year. Trees just don't grow to the sky. But NVIDIA is defying gravity here.
They are completely defying the laws of financial gravity. The earnings per share, or EPS expectation, is around $1.51, and crucially, over 90% of their revenue is now coming strictly from data centers.
I remember, and I am dating myself here, when NVIDIA was just a gaming company, the data center division was like a weird little side project.
It was. But they hit $51.2 billion in data center revenue in the previous quarter alone. The gaming division, which makes the graphics cards for your kid's PC, is basically a rounding error on their balance sheet now. They are purely an enterprise infrastructure company.
But here's the trap. And I know traders lose sleep over this every quarter. There is the official number, and then there is the whisper number.
The whisper number is the absolute killer.
Explain that dynamic for the listener who doesn't day trade. Why is there a secret, unofficial number?
So an analyst at Goldman Sachs or Morgan Stanley publishes an official estimate, let's say 65 billion. That is the math based on previous company guidance.
Right.
But the buy side, the hedge funds, the high-frequency traders, the people putting actual billions of dollars on the line, they do their own digging. They look at the global supply chain data.
They track the shipments, right?
Exactly. They count the cargo ships leaving Taiwan.
Mm-hmm.
They look at TSMC output numbers. And they say, you know what? No, I think they're actually going to hit 68 billion. That higher unofficial expectation, that is the whisper number.
So if NVIDIA comes out on Wednesday and reports, let's say, 66 billion.
They technically beat the official estimate. The headlines on CNBC flash bright green and say NVIDIA beats expectations. But the stock tanks anyway.
Because the hedge funds were betting on 68 billion.
Exactly. They missed the whisper. And we have seen this happen very recently. NVIDIA stock has dropped after earnings in 3 of the last 4 reports, even when they technically beat expectations.
That is just brutal. You literally make more money than any company in human history, and the market punishes you for it.
It is, because the market currently prices in utter perfection. When a stock is up this much, good simply isn't good enough. Great isn't good enough.
The guidance has to be legendary.
If Jensen Huang, the CEO, comes out and says we had a spectacular quarter and next quarter will be spectacular too, the market might literally say, well, we want you to say it'd be miraculous, so we're selling.
Let's talk about impossibly high standards. Let's look at the valuation as it stands today. As of right now, the stock is hovering around $188. Market cap is roughly $4.6 trillion.
Making it the most valuable company in the world. Bigger than Apple, bigger than Microsoft.
But is it actually expensive?
That is the multi-trillion-dollar question right there. And the answer might actually surprise a lot of people. If you look at the P/E ratio, price to earnings, it is trading at a forward multiple of roughly 25 to 31 times earnings.
For a tech high flyer, that doesn't sound overwhelmingly high. I mean, Tesla used to trade at 100 times earnings. Amazon was over 100 for practically a decade.
Exactly. And here is the really crazy insight. This current valuation is actually lower than NVIDIA's 3-year average, which historically sat around 75 times earnings.
Wait, so NVIDIA is functionally cheaper right now relative to its earnings than it was before this AI boom really took off?
Yes. Because the actual earnings is growing so incredibly fast that it is outpacing the massive run-up in the stock price. There is a metric called the PEG ratio. Price earnings to growth.
I love the PEG ratio. It is the great equalizer in finance.
It really is. A PEG ratio of 1.0 is usually considered fair value. Anything below 1 suggests a stock might be undervalued relative to its growth rate.
And what is NVIDIA's?
NVIDIA's PEG ratio right now is sitting around 0.73.
0.73. So by that specific metric, the most valuable company in the entire world is technically on sale.
That is the core bullish argument. The bulls say, look, you are buying a company growing revenues at 70% for a multiple of 30. That is an absolute steal.
But what do the bears say?
The bears, of course, argue that the growth is just a temporary cyclical spike. They think the spending will inevitably collapse, so paying for peak cycle growth is incredibly dangerous.
And believing that the growth will continue depends entirely on the product roadmap. We have been hearing the name Blackwell for over a year now. That is their current flagship chip.
Blackwell is the absolute king right now. Sales are, to quote the CEO, off the charts. If you decide you want to buy a Blackwell GPU for your data center today, good luck. They are completely sold out through mid-2026.
You literally cannot get your hands on one.
Google, Microsoft, Oracle, xAI, Elon Musk's company, they have bought every single piece of silicon NVIDIA can physically manufacture. And for very good reason.
Why is it so much better?
Because Blackwell offers something like 10 times the throughput per megawatt compared to the previous generation.
And that phrase per megawatt is the absolute key there, isn't it?
That is everything. When your entire business is power-constrained, efficiency is the only metric that matters. If you can get 10 times the thinking power for the exact same amount of electricity, you will buy that chip at any price they ask.
And there is always a big but. In the tech sector, there is something new on the horizon. The successor is coming.
Enter Rubin.
Rubin. Named after Vera Rubin, the famous astronomer, right?
Correct. NVIDIA loves naming things after scientists. The Rubin architecture was officially unveiled at CES 2026 just last month.
And what is the massive leap here? Is it just a faster version of Blackwell?
It is significantly faster, but it is also architecturally very different. It uses something called HBM4, which stands for High Bandwidth Memory Generation 4.
Let's avoid the jargon trap here for a second. Why does HBM4 actually matter to the listener?
You can think of the GPU as a super-fast brain. But a brain is only as good as how fast it can access external information. Memory is basically the highway that feeds data into the brain.
Okay, that makes sense.
HBM4 is like taking that highway and widening it from 4 lanes to 12 lanes. It allows the chip to work on much larger AI models simultaneously without getting bottlenecked waiting for data.
So it fundamentally solves the traffic jam inside the processor.
Exactly. And they are promising a 3 to 5 times performance leap over the Blackwell chips.
Okay, so here is the strategic risk I see. If I am Satya Nadella sitting at Microsoft and I know Rubin is coming in late 2026 and it is 5 times better, do I stop buying Blackwell today? Do I just wait?
You have just perfectly described the air pocket risk, or what the industry called the Osborne effect,
The Osborne effect.
named after the Osborne Computer Corporation back in the 80s.
Yeah.
They pre-announced that a much better computer was coming soon, and sales of their current computer immediately dropped to zero because everyone just decided to wait. The company went bankrupt before the new one launched.
Could that actually happen here? Could NVIDIA's sales fall off a cliff for 2 quarters while Amazon and Google just wait for Rubin?
It is a theoretical risk that analysts worry about. But the counter-argument brings us right back to the cost of inaction we talked about earlier. These hyperscaler customers are locked in a deathmatch.
Right, they can't afford to pause.
If Microsoft stops buying chips for 6 months just to wait for Rubin, and Google keeps buying Blackwells during that time, Google might train a far superior model 6 months earlier. And in this specific economy, being 6 months behind is like being 10 years behind.
So they literally have to buy the quote-unquote worst chip today just to stay in the game.
Correct. It is a true arms race. You do not wait for the next generation tank if the war is happening outside your window today. You buy what is on the shelf right now.
Speaking of war, and I really don't use that term lightly here, let's zoom out a bit to the geopolitical map. Because it is not just massive corporations buying these chips anymore, it is actual countries.
Sovereign AI. This is a massive new growth vector for NVIDIA, and frankly, it is one that structurally stabilizes their revenue.
Because countries don't go bankrupt as easily as companies.
Exactly. Companies might have sudden budget cuts. Nations usually don't.
Explain the concept of sovereign AI. Why does a country need to build its own AI infrastructure?
It comes down to data sovereignty. Take a country like France or Japan or Saudi Arabia. They do not want their citizens' personal data, their sensitive medical records, or their government secrets being processed on servers owned by American companies sitting in Virginia.
Right. That is a huge security risk for them.
They want dedicated AI factories, physically located inside their own borders and subject to their own sovereign laws.
So they're writing massive checks just like Amazon is.
Huge checks. Look at Saudi Arabia, for instance. They have the Humane Project. They just announced a $15 billion investment at LAP 2025. They are deploying 500 megawatts of localized compute.
And what about the UAE?
The UAE is arguably even more aggressive. They are currently building the largest AI campus outside of the United States. They are targeting 5 gigawatts of total capacity. They're literally trying to pivot their entire national economy from oil directly to intelligence.
That is a profound structural shift. From oil to intelligence.
And Europe is desperately trying to catch up right now with a 200 billion euro AI continent action plan. Japan has allocated 1 trillion yen annually. Everyone everywhere is buying.
Except, well, there is one major global player who is actively being kept out of the store, China.
Ah, the China question.
Mm-hmm.
This is where the geopolitics gets extremely sharp.
Mm-hmm.
The U.S. export controls on these chips remain very, very tight. The Biden administration started the heavy restrictions, and the Trump administration has ramped them up further. The U.S. government fundamentally does not want China to have the cutting-edge chips, the Blackwells or the Rubins, to train advanced military AI.
But NVIDIA is ultimately a business. They clearly want that massive revenue stream from China. So how are they navigating this ban?
They have to carefully thread the needle. They essentially created specific modified chips, the H20 and the H200, that are mathematically throttled to fall just barely below the performance threshold that the U.S. government bans.
So they are gimped chips, effectively.
They are purposely held back, yes.
But is China actually buying them? Or are they just saying, forget it, we will build our own domestic industry?
They're absolutely buying them because even the throttled NVIDIA chips are still better than anything else readily available on the global market.
Right.
But you are right, they are also furiously trying to build their own domestic alternatives. Huawei has a chip called the Ascend 910C.
Is it actually any good?
It is okay. But the independent benchmarks show that the NVIDIA H200 is roughly 60% more powerful in real-world AI training tasks. So domestic Chinese hardware is definitely lagging. They are fighting this war with one hand tied behind their back.
However, I saw a really interesting note here in the research about a company called DeepSeek.
Ah, yes, DeepSeek. This is the big however in the China narrative.
Right, because DeepSeek released a model called R1 recently that genuinely shocked the Western tech world. Why was it such a big deal?
Because it was incredibly good. But more importantly, it was trained on that cheap restricted hardware we just talked about.
Oh, wow.
It proved definitively that Chinese companies can still fiercely compete on software efficiency. Think about it this way. If you can't get a faster car, you just learn to drive much, much better than the other guy.
So they optimized their code to squeeze every last drop of performance out of the older chips they have access to.
Exactly. Necessity is the mother of invention.
Okay, so we have painted a pretty incredibly bullish picture so far today. Massive hyperscaler spending chips are sold out for years, nations are lining up to buy. But we have to look at the downside risks. Because if you look closely, there are some serious flashing yellow lights out there.
There are, and if you are an investor, you need to take them very seriously.
Let's talk about circular deals. I have to say this sounds incredibly sketchy. What is a circular deal in this specific context?
It is a financial phenomenon that has some forensic accountants very, very worried right now. Here is how the loop works. A tech giant, or let's say a major cloud provider, buys billions of dollars of chips from NVIDIA.
Right, and NVIDIA happily records that as revenue. Great, money comes in.
But then NVIDIA takes some of that massive profit and they turn around and invest it back into that very same tech giant or into an AI startup that is entirely hosted on that tech giant's cloud.
Ah, I see where this is going.
And then that startup takes that fresh investment capital and uses it to buy, you guessed it, more chips from NVIDIA.
So wait, I give you $1 for a silicon chip. You take that dollar and invest 50 cents back into my startup. And I use that same 50 cents to buy another half a chip from you.
Exactly. It dramatically inflates the top-line revenue figures for everyone involved. It creates this closed echo chamber of money.
Wow.
So the big question becomes, is this sustainable organic revenue driven by real end-user demand? Or is it an accounting bubble where the exact same money is just moving in a circle? If NVIDIA suddenly stopped investing, would the massive buying wave instantly stop?
That is a terrifying thought. And that leads directly into the biggest fundamental risk of all, the ROI gap, the return on investment. We talked extensively about the $700 billion being spent by the hyperscalers, but what is the actual revenue on the other side of this equation? Who is actually buying the AI services that require $700 billion to build?
This is the massive math problem of 2026. The tech industry as a whole is spending roughly $700 billion a year on physical infrastructure. But if you look at the pure play AI vendors, the companies actually selling AI products like OpenAI, Anthropic, Cohere, their combined annual revenues are estimated to be maybe $35 billion total.
Wait, spend $700 billion to make $35 billion. That is a completely catastrophic business model.
On paper right now, it looks absolutely terrible. The ratio is wildly off. Historically, in the tech sector, you want a 1-to-1 ratio. Eventually, you spend $1 on a data center server, you make $1 in software subscription sales. Right now, we're basically spending $20 to make $1.
So why aren't investors fleeing in absolute panic? Why is the stock still sitting at $188 today?
Because the core argument from Silicon Valley is that this specific infrastructure isn't just for running today's slightly clunky chatbots. It is being built for the next 10 to 20 years of all computing. They argue we're currently in the heavy installation phase. When you decide to build a transcontinental railroad, you have to spend billions and billions of dollars on steel and land and dynamite long before you ever sell a single $2 train ticket.
So we are just laying the tracks right now.
We are laying the tracks across the entire globe. And they firmly believe that trains, the massive killer apps, will eventually come. They are betting on AI doing revolutionary drug discovery, creating new material science, or autonomous digital agents
Yeah.
that literally do your daily job for you.
But
But right now, yes, the tracks are unimaginably expensive and the trains are very, very small.
that connects directly back to the physical power issue we discussed. Because if we run out of electricity, the track's just stopping build.
And we very well might run out. The global power grid is the hardest physical bottleneck in this whole story. You can easily print more fiat money, but you
Wow.
cannot just print electricity. It takes 5 to maybe 10 years to permit and build a new high-voltage transmission line. It only takes 2 years to build an AI data center. That severe temporal mismatch between the grid and the silicon is the biggest physical risk to the entire AI story.
Before we wrap this up, I want to pivot slightly to Meta, because Mark Zuckerberg seems to be doing something really weird compared to the others.
He's playing 4D chess right now while everyone else is playing checkers.
So Meta is spending up to $135 billion on this infrastructure, but they are completely open sourcing their core AI models, Llama. They are literally giving the digital brain away for free. Why would any CEO spend a fortune to build a supercomputer that just makes a free product?
It is the ultimate Android strategy. Zuckerberg deeply believes that if Meta creates the standard underlying operating system for AI, meaning if every startup builds on top of Llama simply because it is free, then Meta effectively controls the entire future ecosystem. He doesn't need to directly sell the AI model. He monetizes human attention. If the absolute smartest AI in the world powers Facebook, Instagram, and WhatsApp seamlessly, you will never ever leave his walled garden of apps.
So he essentially wants to own the very soil that everyone else has to grow their crops on.
Exactly. It is a staggeringly expensive gamble. But if it actually works, he fundamentally locks in global tech dominance for the next 20 years.
So bringing this all back to the listeners sitting at home or driving in their car, why should they ultimately care about any of this deeply technical stuff?
Because this isn't just about watching a stock ticker fluctuate next week. We are actively watching the largest industrial and infrastructural build-out in human history happen in real time.
Right.
It is fundamentally reshaping global energy markets, meaning your local electricity bill might actually go up directly because of this. It is dramatically reshaping geopolitics and national security. It is reshaping how literally every single company on Earth operates.
So NVIDIA really is the Standard Oil of this new era.
They are the ultimate utility provider of the 21st century.
So what is the final verdict for next Wednesday? What actually happens when the numbers drop?
Based on the raw data and the recent historical precedent, it is very, very possible the stock drops next week.
Even if they report a massive beat.
Even with a massive beat. The short-term expectations are just too incredibly high, but, and this is the vital takeaway, the massive institutional investors, the big smart money like Ray Dalio, they aren't panic selling.
They are buying the dip.
They are buying more. They view any post-earnings drop as a generational buying opportunity. They see this entire situation as a permanent structural shift that will last well past 2030, not just a quick day trade for next Tuesday.
So the message is don't panic if you see a sea of red on your trading screen Wednesday morning.
Look strictly at the underlying fundamentals. Look closely at the CapEx guidance from the other tech giants. If Amazon and Microsoft and Google are still relentlessly spending billions, NVIDIA is still fundamentally winning.
I want to leave everyone listening with a final provocative thought, something to really chew on over the weekend.
Let's hear it.
We used that railroad analogy earlier. The idea that we are building $700 billion worth of brand new railroads every single year. But the cargo, the actual massive software revenue, hasn't shown up at the station yet.
Right.
So are we brilliantly building the necessary infrastructure for a golden age of human prosperity? Or are we accidentally building massive ghost cities of compute?
That is the exact question that haunts me at night.
Think about it. Are we going to look back in a decade at these massive, sprawling data centers out in the desert consuming the power of literal nuclear plants and see them as the glorious engines of the future? Or will they just be empty, silent monuments to a financial bubble, just giant concrete monoliths waiting for an AI that never actually got smart enough to pay its own electric bill?
It's a chilling visual.
But let me take that one step further. Even if the models do eventually hit full AGI, what if the $700 billion of silicon infrastructure we just rushed to build is completely the wrong type of hardware. What if a sudden breakthrough in biological computing or specialized quantum computing renders every single one of these gigawatt silicon ghost cities utterly obsolete overnight? What happens to the global economy when $1 trillion of fresh infrastructure instantly becomes e-waste?
That is the true black swan event right there.
Yeah.
Because in tech, the paradigm shift always comes from the direction you aren't looking.
A very expensive calculator or the literal dawn of a new species. No pressure, Jensen.
No pressure at all.
Well, that is it for this deep dive. We highly encourage you to watch the massive earnings report next Wednesday with all of this new context in mind.
Look right past the flashy headlines. Look directly at the customer backlog. That is where the real story lives.
Thanks for listening, everyone. We will see you on the other side of the earnings call.